Hello, and welcome to today's Business Transformation 101 podcast. I'm your host, Bill Fegis, and today we will be discussing lean accounting. When a business implements lean processes and is traveling on a successful journey of endless continuous improvement, the culture and approach to business is completely transformed. To truly achieve success in a lean transformation, the business also needs to transform how it measures the financial performance of the business. This is necessary since traditional standard cost accounting does not provide the right information in a timely fashion to operate the business in a lean environment and can obscure the improvements made by a lean implementation. The accounting must be aligned with the lean processes. This new approach to describe and measure financial performance in a lean business is called lean accounting and is often described as plain English accounting. In general, lean accounting is not widely understood and deployed when lean processes are implemented in manufacturing and on the transactional areas of the business. Transforming a business from traditional standard cost accounting to lean accounting is a significant task that should be done in parallel with the operational transformation. There will likely be strong pushback from the auditors and financial organization due to the significant change in the accounting approach. The resistance to change in accounting processes is no different than the resistance that was undoubtedly present in the manufacturing organization when lean forced a change from the traditional batch and queue system to a one-piece flow system. This podcast will provide a high-level comparison between traditional and lean accounting to provide some insight on the rationale for making this transformation. To get more detailed insight, explore the references listed at the end of the LinkedIn article on this topic. Let's start with an overview of traditional standard cost accounting. Many businesses are manufacturing in a batch and queue mode and running a standard cost system to provide financial information on the performance of the operation. In this approach, they are running large batches to amortize overhead expenses and the cost of long setup times over a high volume of units. A standard cost system periodically sets a standard cost for each item in inventory. If the item is raw inventory, the item will have a standard cost. Typically, this standard would be set annually based upon the most recent purchase price or perhaps an average purchase price for the past 3 months. If the actual purchase price varies from the standard, a material variance is booked. This variance could be positive or negative and is typically referred to as PPV or purchase price variance. If the item is a product manufactured by the business, the standard cost will be set by rolling up the standard costs of the materials, summarized in the product's bill of materials, plus the standard number of labor hours and standard labor rate for producing the product, plus a standard burden rate to cover overhead expenses. Typically, overhead burden rates are applied to the labor hours. When a product is manufactured, any variances to material cost, material usage, labor rate, labor usage, overhead spending, or overhead volume, that is, actual volume versus budgeted volume, are reported as manufacturing variances in the income statement. Note that these variances are all relative to the budget, which is built upon the standards and sets the burden rates. This standard cost approach has some weaknesses since it's based upon the budget, which is typically wrong from day one of the budget period. This can result in the perception that certain products are making money and others are losing money when that is not the actual case. It is not uncommon for a business running a standard cost accounting approach to have manufacturing variances to standard of 200 to 500 basis points. For example, an income statement shows COGS, or cost of goods sold, at standard cost of 60% of sales, but actual performance results in a manufacturing variance of 300 basis points, which means the reported COGS is 63% of sales. If operating decisions are made based upon the COGS of products at standard cost, leadership can miss a significant cost variance that is producing an actual gross profit that is below the expectations set in the budget through the standards. The standard cost approach also provides incentives to build inventory which, as we noted in volume 16 of this series, a primer on lean, is one of the 7 wastes. In a standard cost system, the overhead is absorbed at a standard burden rate that is applied to labor hours used in producing product. It does not distinguish whether the products were built and shipped or built and placed in inventory. Products that are built and placed in inventory absorb overhead expenses and essentially defer the overhead expenses to the balance sheet as part of the inventory cost. This makes the period income statement look better since some portion of the overhead expense for the period has been deferred into a future period. However, this overhead expense, which has been deferred into inventory, will adversely impact the income statement in the period when the inventory is shipped, since shipping this item out of inventory will not absorb any of the overhead expense for the period and can result in underabsorption for the future period. So the favorable gross profit variance that occurred in the period when the item was built and placed in the inventory will cause an equal unfavorable gross profit variance when that item is shipped out of inventory in a subsequent period. This absorption accounting can lead to poor decisions such as overproducing inventory to make the income statement look better in the period, when the correct solution is to adjust expenses to match demand rather than pushing expenses into inventory, which may not be sold for months, if ever. Let's now take a look at lean accounting. Lean accounting is built around cells and value streams rather than by departments. For example, lean accounting done at the cell level provides actual costs for labor and material by production shift, assuming standard work has been implemented in the cell. At the value stream level, the labor and material actual costs from the cells in the value stream can be rolled up, and overhead costs for the value stream can be included. This provides a measure of the value stream gross profit by shift. Any overhead not directly assigned to a value stream should be put in a shared overhead account. This approach provides a clear view of COGS and gross profit by value stream. Let's consider an example lean accounting implementation. The business designs, manufactures, markets, and sells industrial electronic products to OEMs. The business historically used a batch and queue approach in manufacturing that was done in 2 separate facilities. The manufacturing facilities did not contain any R&D or sales marketing expenses. Over several years, the business transitioned their manufacturing to a lean one-piece flow process. In the lean configuration, each of the 2 manufacturing plants were considered a value stream, and each had multiple cells making up the value stream. The team implemented lean accounting in the plants. The lean accounting system included visual management boards at each cell in both plants and a value stream level board for each entire plant. The lean accounting board showed the actual costs incurred by the cell on each shift. The costs shown included direct labor, direct material, variable overhead directly used by the cell, and fixed overhead directly used by the cell. At the end of each shift, the team knew the COGS generated on that shift by the cell. Note, since this is a lean cell, the cell only builds products to customer demand, so there is no overproduction of finished goods inventory that would go into stock. The direct labor and direct materials used by the cell are calculated based upon the direct labor hours and rates for the employees working in the cell during the shift. Direct material used in the cell during the shift is calculated based upon the bill of materials for the products produced and is automated in the IT system through a backflushing process. This bill of materials utilized the actual material costs rather than standard material costs. The variable overhead was calculated based upon the variable overhead used directly by the cell during the shift. For example, consumable materials, labor benefits, etc. The fixed overhead calculation included only the fixed overhead used directly by the cell. For example, building rent and utilities based upon the space occupied by the cell. Manufacturing engineers assigned to the cell, buyers assigned to the cell, etc. At the value stream level, any variable or fixed overhead that could not be directly assigned to the cells was booked in a shared overhead account, and this included, for example, the plant manager, HR manager, quality manager, unassigned building rent and utilities. That is, any building space that was not utilized by the cells. The value stream level visual management board showed the shared overhead expenses plus the COGS from each of the cells to provide a total actual COGS for the plant for every shift. This approach allowed the team to know the actual costs for every product produced in each cell for every shift, and this financial information is displayed in plain English on the visual management boards. The team also knew the shared overhead for each shift. This allowed the team to review and analyze the shared overhead to determine what could be directly assigned to the cells or eliminated. Some of this overhead is waste and should be eliminated, while some is necessary but cannot be accurately assigned to each cell, for example, the plant manager or HR manager expense. Note that one of the other advantages of the lean accounting approach described in the example is that the team knows the financial situation to the gross profit level on a shift-by-shift basis. Instead of waiting until the books are closed at month end to understand the performance of the cell, the value stream, or the business, they get a snapshot every shift. This allows the team to correct issues daily rather than having issues linger until month end and result in a big performance surprise. As the business transitions from traditional accounting to lean accounting, the team is simplifying the old financial monitoring and tracking systems and in many cases eliminating them over time. In a lean business, the team needs appropriate financial KPIs at the cell, value stream, and business levels. The metrics should be selected to provide the team with the information they need to identify the root causes of problems in a simple, timely manner so countermeasures can be implemented quickly. When transforming a business from a traditional batch and queue system to a one-piece flow lean system, the method of accounting should be transformed to ensure the team has clear, accurate information to operate the business successfully. Batch and queue businesses typically employ traditional standard cost accounting to measure the financial performance of the business and provide information to operate the business. Many companies move their operations to a lean system but maintain the standard cost accounting approach. This is a mistake since the standard cost approach is mismatched with lean processes and will provide bad information to the team operating in a lean manner. For example, the standard cost approach incentivizes the team to build inventory, which is counter to lean, which is working to reduce or eliminate inventory. A business operating with lean processes should install a lean accounting system to measure performance and provide the right information for operating the business. A lean accounting system operates off actual cost versus standard cost and provides detailed information at the cell and value stream level to give better information on financial performance and any variances that occur. This information is available on a shift-by-shift basis in a visual manner rather than waiting until month end to find out what went right or wrong. Lean accounting should be implemented in parallel with any lean operating system. In the interest of continuous improvement, I invite feedback from our listeners. Please share your thoughts and ideas on these weekly podcasts and feel free to suggest topics which you believe would prove useful for you and our listeners. Thank you for listening to this week's podcast, and please join us next week to discuss the 5S process.